Hello. In this video, we're going to go through anti-dilutive securities. Before we get into that, let's go over what basic earnings per share calculation is. And when we calculate basic EPS, we're going to take our earnings available to common shareholders, which really means our net income less any preferred dividends paid, accrued, or owed, divided by the weighted average number of common shares outstanding. It is really important to know this basic calculation and understand what goes in the numerator versus the denominator, because it'll come into play later in this video. There are two types of earnings per share. There's the basic earnings per share and diluted earnings per share. If a company has a diluted earnings per share, they must report both the basic and the diluted. If they don't have any diluted EPS, then they have to report just the basic. So what is diluted EPS versus basic EPS? The diluted EPS incorporates all the dilutive effects of potential common shares. And how do we get potential common shares? They derive from securities that can potentially have common stock issued through their exercise, conversions, or issuance. The most common dilutive securities are convertible bond stocks and convertible bonds, convertible preferred stock, and stock options, which if you are not familiar with these items, please go see prior videos. This video assumes that you've watched the videos on basic earnings per share and the two diluted earnings per share videos that came after that, and because we're going to keep layering on what we learned in those previous videos. So when we do, when a company has to report their basic and diluted earnings per share, they only report their diluted earnings per share if it is less than the basic earnings per share. If your diluted earnings per share ends up being higher than basic, you do not report it. And the reason for that is it takes the conservative approach to your readers of the financial statement, because you don't really want to show a diluted earnings per share that is higher, because it might mislead your readers to think that, you know, the potential is that the earnings per share might be higher. And there's a lot of assumptions that go into the diluted earnings per share. So just to be conservative, it is only reported if it's less than the basic. Let's start talking about some of these dilutive securities that affect the diluted earnings per share. Let's start with options, warrants, and rights. And these are all similar in that they give the recipient a right to purchase the stock in the company for a specific price, okay? And then when they do, when the recipient exercises them, they usually just turn around and sell them if the market price is higher than the exercise price, which is that fixed price I was referring to. And let's go through, see what happens with stock options, right? What happens to our EPS? Because we assume that for diluted EPS purposes, we have to assume that they're all exercised. So you might notice, be familiar with this slide from the stock option video for diluted EPS. We have exercised 15 million common shares at $20 per share. That's our this is our exercise price. We get $300 million, okay? Then the company, this is what is assumed, the company takes the $300 million and buys back those shares with that cash using the average market price, which would give them 12 million shares. And we say, okay, well, we sold 15 million, we bought back 12 million, so we have a net increase in our EPS calculation of 3 million shares. So our denominator, right, our denominator increases by 3, and therefore our diluted EPS is going to go down. When our denominator goes up, our EPS goes down. Now, what happens if, let's just say, same example, 15 million shares, exercises $20, so assume the company receives $300 million. Then they're going to take that $300 million and buy that stock back with that cash. Except in this example, our average market price is $15. It is less than the exercise price of $20. Well, then what happens is that we can buy back 20 million shares, and then what happens to our EPS, to our denominator? Well, we've sold 15 million, we've bought back 20 million, right? So we've reduced our outstanding shares, common shares outstanding, by 5 million. And therefore, we have now reduced our denominator in our earnings per share calculation, which makes our earnings per share go up. If a security makes your earnings per share go up instead of down, it is considered what's called antidilutive, and we do not include it in our diluted earnings per share calculation. So let's an example that you've seen in previous videos, so I'm going to go through it really quickly. So Rand Financial Corporation reported net income of $154 million in 2027 with a tax rate of 25%, and its capital structure included the following. And we had all these transactions, which are all in our basic earnings per share video. Okay, so up to here is what we calculated earnings per share, our basic earnings per share. And I'm just going to tell you that our basic earnings per share is $2. Okay. Now, then we had all these other convertible or dilutive securities that affected our diluted earnings per share. Now we're going to include this stock warrants, the one that's in the red font, and warrants granted in 2026, exercisable for 4 million common shares at an exercise price of $32.50. Well, we said if our exercise price is higher, than the average market share, then we already know that it's going to make our diluted earnings per share go up, and therefore we just don't include it. And we're told in this, We're told in this problem that the average market price of the common shares during 2027 was $25 per share. So this situation, the $32.50 is higher than the 25, and so therefore we would just not include it in our diluted earnings per share calculation at all. It also would not be included in our basic earnings per share because it is a dilutive security, and dilutive securities are not included in the basic EPS calculation. When we talk about to see what happens when convertible security has an anti-diluted effect, that means makes the EPS go up rather than down, we have to go through this first four-step process. The first step is we have to calculate our basic earnings per share. And in the example we're going to use going forward, our basic earnings per share is $2. The next step, step 2, right here, is we have to calculate the incremental effect of each of those convertible securities. And I'm going to go through what that means, the incremental effect, before we go to the next two steps. Okay, same problem. Okay, we have our basic EPS. Through here is our basic EPS, and these are all of our convertible securities. And we're going to focus on convertible bonds. We have an 8%, 300 million face amount issued in 2026, convertible into 12 million common shares. Now with convertible bonds, the earnings per share is going to, our numerator is going to go up, and our denominator is going to go up as well. Our numerator is going to go up because we're going to eliminate the interest expense component from the bond, because if we convert the bond, then we're not paying out interest anymore, so we don't get to take that interest expense. And the way we calculate the interest expense, the way we calculate the increase in the numerator is we're going to take the interest expense multiplied by 1 minus the tax rate. The interest expense is going to be the 8% that's on the face of the bond times the face value, which gives us 24 million. So the increase to the numerator remember, this is just the numerator in the EPS calculation, is going to be our interest expense times 1 minus 25%, and that equals 18 million. That's going to be the increase to the numerator. We also are going to have an increase to the denominator because we're increasing our number of shares outstanding. So when we look at our incremental effect of each of these convertible securities, I'm going to take my $18 million increase to the numerator divided by the 12 million increase to the denominator. And so 18 divided by 12 gives me $1.50. And I'm going to compare that to my basic earnings per share. If my incremental amount is less than my basic earnings per share, then I'm going to include it in my layering process when we get to step 3 and 4, okay? Now let's look at the preferred stock, okay? We have preferred stock that's convertible into 3 million common shares, okay? But we have 5 million shares of preferred stock at 8% times $10. Recall that your numerator for your earnings per share is your net income minus your preferred dividend. That's going to be my numerator. So if we convert these preferred stock into common stock, we no longer have a preferred dividend that we have to reduce our net income by. So we have to add it back. So how do we calculate that preferred dividend? We're going to take the number of shares of preferred stock, multiply that by the percent that's on the preferred stock, multiply by the par value. So we're going to take our 5 million shares, multiply by 8% times $10. That means our preferred dividend was $4 million. So now our numerator is going to increase by $4 million. And then our denominator is going to be our average weighted number of common shares outstanding. We've converted those preferred shares now into 3 million common shares. So now we're going to increase our denominator by 3. So when we look at the incremental effect, we just take the effect of that specific convertible security and calculate what that incremental effect is. And in this situation, 4 divided by 3 is at $1.33. Again, that is lower than our basic EPS, basic earnings per share. So we are going to include this also into our layering process when we calculate our overall diluted earnings per share. Let's go through that. So we've just talked about the incremental effect of the conversion. If the incremental effect is less than your basic earnings per share, it is considered to be dilutive. If, however, your incremental effect of conversion is greater than your earnings per share, then it would be considered anti-dilutive, and we would exclude that convertible security in our layering process altogether. Let's go through what I mean by this layering process. This is kind of step 3 and 4 kind of go together. So for each incremental convertible security that is less than your basic EPS, you're going to say, what if I add this one piece to my basic EPS? And what does it do? If it continues to reduce your earnings per share, you include it and move on to the next convertible security. However, if that one incremental convertible security, when you layer it on, it increases your earnings per share, you stop and you're done with the whole process and you have your final diluted EPS number. Let's see what I mean by that. Here we have our example where we have our basic earnings per share, and which is net income minus preferred dividends, right? And which is 154 minus the 4 million preferred dividends is $150, and we had 75 million average common shares outstanding, which is how we got our $2 per share basic EPS. Now back to our convertible securities. We did the conversion of bonds and conversion of preferred stock. Okay. Notice we don't have those warrants here because they were anti-dilutive from the start, and we don't include them in this layering process. So which one do we add first? Because it's not just ad hoc. There's you see this one, the conversion of bonds, the incremental effect was $1.50, and the conversion of preferred stock, the incremental effect was $1.33. Well, we include the lowest one. We go from lowest to highest. So in this situation, the preferred stock one is lower. So we're going to layer that in first. So remember, lowest to highest. So when I look at that, right, here's my basic EPS calculation over here. When I layer in the conversion of the preferred stock, I have to remove my $4 million dividend from the numerator, and I'm going to increase my denominator by the 3 million common shares that I converted into. And so now my new numerator is 154, my denominator is 78. So my new earnings per share is $1.97. And you look at this and you compare it to the prior EPS, which in our case happens to be the basic. And if it's less, okay, if it's still less than your $2, then you say, check, I'm going to include this in my diluted EPS calculation. Now we have the conversion of the bonds, right? Because we'll go from from lowest to highest. So now we have to add in this into our calculation. So now we have we removed our preferred dividends. Sorry. We removed our preferred dividends. I'm looking at this bottom one right here. And now our after-tax interest savings is that $18, right? This is $18. And then when we look at our denominator, we started with our 75. We added 3 for the preferred dividends. And now we're going to add 12 to our denominator for the conversion of the bonds. So now our numerator is 168. And our denominator is 90, and our new EPS is $1.87. In this situation, I just wanted to point out that this $1.87 is compared against the previous layer of EPS, which is $1.97. If it's less, then we include the conversion of the bonds in our diluted EPS. Okay, do not compare this layer to the basic EPS, okay? You have to always compare it to the previous one. So what if our number ended up being not $1.87, that the math worked out differently, but it was actually $1.99? Well, even though that $1.99 is less than your basic earnings per share, that's not what you're going to compare it against. You're going to compare it against the previous layer EPS, which was $1.97. And in this situation, it increased, which means that this would be considered, the conversion of the bonds would be considered anti-dilutive. And you would not include that conversion of bonds layer into your diluted EPS, as well as if you had any other convertible securities, you would just stop. You wouldn't layer any of it. Your diluted EPS would actually just stop right here, and you would report that your diluted EPS is $1.97. I do want to point out that when you have stock options, and if your stock options are dilutive, meaning that the exercise price is less than the average market price, then you immediately layer it onto your basic EPS. Okay, so your stock option exercises is immediately layered onto your basic EPS, and then you start your layering of your incremental pieces of convertible securities one by one from lowest to highest.